Hello, and welcome to Comprehensible Confusion, where we take the confusion in the world and make it just a little bit more comprehensible. I'm Saint of Virtue, or just Saint for short, and I'm going to continue talking about houses, and today we're going to talk about equity on your house. First off, in order to have any equity on a house, you need to have made multiple payments on it, because basically the equity is how much of your house you have paid off. So if you've paid off half of your mortgage, well, your equity would be half of the cost of the house or half of your mortgage. And the other thing about it is we can also refinance. This occasionally will be a very beneficial thing for you. But first off, we got to take into account what is this? How do we generate equity? Well, first off, we do it by making our monthly payments. In our case, we have a monthly payment of 2 gold blocks. So we'll move our iron golem from out of the way and pay 2 gold blocks. This is our monthly payment. As you can see, we have 24 gold blocks paid already, which means we've been doing this for 2 years and 1 month now. So we're starting to get a little bit of equity. Now, the interest is removed from the total payment. And interest is one of those sneaky little factors. It's how the banks make their money off of a mortgage. And basically, if you have a mortgage rate of 1%, that means 1% of the remaining mortgage needs to be paid per year. So you would pay a twelfth of a percent each time. In our case, it's easier to think of it as, say, 50-50. So if we have 24 gold blocks, we can say 12 of it went towards the equity and 12 of it went towards the interest. That would be a ludicrously high interest rate. Normally, you would expect it to be, you know, like I said, about 1%. And the interest rate actually is the reason why you tend to generate more equity the longer you have a property. Because the longer you have a property, the more you've reduced the total amount you pay on your mortgage, which means you've reduced the amount of interest that is being made. So you may be making the same payment, but instead of half of it going towards interest, maybe only a quarter of it is going towards interest. So the longer you have a property, the more goes towards the equity of your monthly payment. But what if you wanted to use some of your monthly payments? And this is basically your equity. How much of your house mortgage you have paid off. So in our case, we have paid off, well, only 12 blocks because we've paid 24, but well, only half of it is going towards the actual mortgage itself. Now, how do we actually turn this into something we can use? Well, and what we will do is we will refinance the house. And you can do this even if you don't want to generate equity. You can put it all back in. And the reason you would do this is you could find a better rate for your monthly interest or your yearly interest. And if you can find a lower yearly interest, so you pay more on your mortgage and less on the interest, you can pay it off quicker and you will own your entire house sooner and you'll generate equity faster. And the process for refinancing is it's basically taking out a brand new loan, going through all the same steps you went through in the first place to create your mortgage. In this case, however, you have a lot of collateral. You have a whole house. So it's usually more likely to occur and you need less down payment because your house is already providing that down payment with your equity. But it is still, in essence, a new loan. It is a new loan or a new mortgage for the cost of the house. And if you take that out, you start paying as if you've never made any payment, provided you keep the equity. You could reinvest the equity into the house, but you would only do that if it's just a pure refinancing. And that would just be taking how much you've paid and just paying off that much of the loan already. Now, the advantage of not doing that and taking just the equity on your house is that you get however much you've got on equity down. So you could get a good chunk of money. And depending how long you've owned the house and how much you've been paying monthly, you could get a large amount of money. But the downside is your mortgage is basically reset as if it's, never occurred. And like I said, your house is still your collateral. It's basically just a reset on your mortgage and you get the money that you've already put in. Banks like to do this because if they reset the mortgage, that's where they're making the most money in the early years of the mortgage. So for them, it's a great benefit. And because of that, you're trading some time on your loan. You'll be paying a lot more money overall. But you do get a cash infusion. You will get your equity as cash on hand. And having cash on hand can be a very valuable thing in case of an unexpected expense. But however you care to do it, it's entirely up to you. But used properly, refinancing and equity can be a powerful tool to improve your quality of life. I hope I made a little bit of this confusion on the house market a little bit more comprehensible, and I hope you all have a wonderful day.